Good morning. This next slide has nothing to do with real estate in Houston, but I don't know about you, but that's kind of how I felt after the recent election cycle. And I know we're all glad that it's over. I will attempt to predict what happens as we move into 2013. I'm told I lucked out last year and got it right, so the odds of me getting it right 2 years in a row are slim, so I warn everybody with my predictions. The recent election has really kept a lot of us preoccupied. Now it's over. A lot of companies, corporations were kind of putting all decisions on hold until they determine the outcome of some sort of predictability, and we're now seeing all of those things loosen up now that we're beyond that hurdle. Houston has been called many things in the past few years. Energy capital of the world, city of opportunity, and the latest, most recently, that my kids have reminded me of, we're now the coolest city in the nation. It seems that no matter what's going on in the nation, Houston keeps pressing forward. We've gained nearly 50,000 new young professionals. Population is over 6 million, making us continue to be the fourth largest metropolitan area in the nation. We had 2.6% job growth in the past year, so our unemployment rate is now down to 7.3%. There's a lot of uncertainty around the national economy, but as Bob said earlier, Houston is really the best city to be in to endure this recovery. And of course, to top it all off, as my friend Ron Messner would remind me, we now have the #1 ranking football team in the NFL. So. The Houston industrial market totals roughly 843 million square feet. And as Jay commented earlier about retail, industrial only has 2 million square feet of space under construction. So supply in industrial is really trailing demand. So that's good for our city, good for the future of, and especially 2013. The third quarter statistics indicate the market fundamentals are well into recovery in Houston for industrial, will continue to grow for the next few years. Our industrial vacancy rate in Houston has dropped to 5.3%, which is down from 5.6% last year. It's also significantly lower than the national market, which is just under 10%. The warehouse sector makes up the largest portion of the market, which has a vacancy rate of 4.8%, which is down from 5.3% at this same time last year. And the flex projects are still struggling a little bit with about a 10.2% vacancy rate. But overall, our fundamentals are strong compared to everywhere else in the nation. We need to get ready for the demand. The strong demand in industrial these days is for crane-ready buildings, and a lot of what we're building is in response to that requirement. Warehouse and distribution centers will need to be able to accommodate large parts and equipment for the oil and gas industry as they restaff and restage the oil and gas activity around the world. The largest projects underway at the end of the third quarter was this state-of-the-art food service distribution facility by Ben E. Keith, 475,000 square foot project on an 82-acre site in Beltway Crossing in Missouri City. There's a Rampart Corporate Center, 131,000 square feet, which is currently under construction. And then our company has a 355,000 square foot facility under construction for Goya Foods in Katy, Texas. Katy is really going to be a next boom area for industrial. Recently, you'll find that Rooms to Go has just expanded. Igloo is expanding as well. Weatherford is building a big plant out there. We have the Goya Foods facility going out there. So I think you'll find that sector of town is really going to explode on the north side of I-10 in the industrial market. On the investment sales side, Houston is really, we've always had a good, strong industrial sales market, but I guess the fundamental difference is we are now really considered a true global gateway city. We have always been considered, one notch below a gateway city for investment sales, but I think you'll find that all of the big institutions and players in the world now consider us a strong gateway city, which is because really mainly related to our port. Most institutional buyers and investors are under-allocated in industrial, and so you'll find a big push in that sector for everybody to get more of that space. There now be 20 bidders for every Class A industrial project on the market, where in the last couple of years you'd only see about half of that. There's really no investment. Most of the investment grade product is either under contract or sold this year, and there's very little product scheduled to come on the market in 2013. So it's really going to be a strong market, and it's going to continue to drive cap rates down. Cap rates have been a wide range in the last year because of the reduction in supply. We've seen cap rates trade down as low as 6% on industrial single-tenant net lease buildings, and depending upon credit, and ranging up as high as 8.5%. But that trend is about 100 basis points lower than it was last year. Last year I talked about Ameriport over in Baytown. They've completed Ameriport 2 recently. There was I talked about last year, a new facility for DiMare Fresh, both of which buildings have been completed. Ameriport 2 was 168,000 square feet. Ameriport has also seen projects from other companies like Flex Steel, Pipes, and others, and cryogenic vessels. DiMare, his project is on 288 South, just south of Loop 610. Citywide industrial rental rates are slightly higher than they were a year ago. There's been a positive net absorption rate of 931,000 square feet recently, bringing our year-to-date total to 4 million square feet of absorption. Some of the new projects, because of the lack of demand, they're breaking ground. They're 43% pre-leased on average right now on the new spec projects. Last year they were 86%, so that kind of shows you the dynamics in the market. The industrial market in Houston is divided into multiple sub-markets. Each one has their own economic drivers and is really a sub-market in and of themselves. As of the third quarter, the Northwest corridor continues to post the highest absorption of 603,000 square feet, and the North submarket that Bob was talking about in the industrial side, we've had a 284,000 square foot absorption over the last year. There were 22 industrial sales in 2012, which is up from 20 the prior year, and our volume is $315 million of industrial sales this year. Largest transaction being the sale of the FedEx Center at Hobby Airport, 256,000 square feet, which sold for just over $39 million. More companies have been considering design-build projects this year because of low interest rates. Build-to-suit has been slower because there's a lot of spec product that's coming out of the ground, and because of the need to occupy quickly, we're seeing a lot of those specs projects being leased up and taken quickly by what would have been build-to-suits, but in order to fulfill their need and get up and operating, they're going into those. It's only natural for people to gravitate to Houston. As we all know, it's the best place to be. Energy is really driving our industrial economy here, as well as the other sectors. Houston is really, as mentioned before by the other panelists, that Houston has really become a job-creating machine, and that's really what's fueling our whole economy here. Our unemployment rate was reduced by 3.5% over the last year. Energy, foreign trade, and healthcare is fueling that growth. As Will mentioned before, Houston's metropolitan area has created more jobs than any other American city, which I'm happy to remind anybody I can meet out of town about. And it really fuels this industrial market. Job stability is really what is giving everyone in the industrial sector the confidence to come out of the ground with more spec products to meet the demand for warehousing. And it's really not just in one area of town, but all over town. The prices for oil recently were $88 a barrel for WTI and $109 for Brent crude. Energy continues to support our region. As oil prices rebound, it's really going to continue to drive our whole economy. As mentioned before, the ExxonMobil, which was supposed to be a big secret, it's hard to keep a secret when you have 12 million feet of buildings coming out of the ground. At some point, everybody knows what's going on. It is amazing. If anybody hadn't been up there, it's amazing to see what's going on up there. In industrial, we're starting to see a lot of activity surrounding that area with different industrial projects to position themselves in order to support the ExxonMobil and other kind of moves that are discussed for that area. ExxonMobil will be likely disposing of a lot of their existing owned buildings that they're relocating out of in 2013 and 2014. That will be really just surplus property, so that'll be some re-tenanting opportunities in various parts of town. Another big economic impact, which I've mentioned in years past, is the Panama Canal expansion. It was originally targeted to open in 2014. The timing on that is slid to, they call it the end of 2014, so I'd say it's likely now 2015. Justin Boyer will probably let us know the day that it's open down there. But that really raises all the expectations. We've talked in the past about the trade from China coming this way as soon as the canal is entered, because what it does is it increases the cargo size. So in 2015, we'll be able to get larger ships through the canal to support bigger cargo. But the big kind of new information to me, the new thing that's really going on is this LNG, the big LNG tankers, and that's where, and all of our plants are located on the Gulf Coast for LNG, and so we can now, with the widening of the canal, get our tankers through the canal back to the Far East, and that is, I think, going to really be a huge boost to our petrochemical industry and LNG and all of those pipelines. We're deepening our ship channel in order to handle some of this bigger product. It's a long-term, it's a good investment. We don't have enough money to do it all in one go, but we really need to keep everybody focused on the deepening of the ship channel. On a quick port side note, the ILA, which is the union that at the port, meets, I think, this month to discuss their contract. If they were to choose to strike, if they were not able to make a deal, that could cause some slowdown of cargo in the port, hopefully only temporarily, but that could cause a dip in cargo if they were to strike, which would likely happen in 2013. On the LNG side, again, Exxon and Qatar have a proposed joint venture to export LNG from Golden Pass, and as we all know, ExxonMobil doesn't do anything, without thinking it through with a long-term strategy. So to me, that really is an indicator that this LNG is really going to be a long-term, byproduct here in the Houston area, and it's something that we can all count on. Eagle Ford Shale, which I also mentioned last year. If you haven't been down there deer hunting, you better leave early because it's hard. The traffic is terrible down there now with all of the Eagle Ford Shale drilling. It's really driving Houston industrial because all of the Houston industrial companies that support oil and gas activity are staging all of that activity out of Houston, designing it, planning it, supplying it, and so that's really, it's really like a gold rush down there these days if you haven't been down for the oil field development. Interesting thing that I found out the other day is there was a lot of money spent, a lot of leases signed down there. A lot of these were only 3-year leases, so these leases come up in a year for all these landowners. And so I think you're going to see a big rush of activity to get drilling going down there in order to hold some of these leases. So I think it's an eye-opener to, I just wish I had a big hunting place down there with some minerals, but I wasn't smart enough to do that. But if you are planning your next vacation down to Dilley or Cotulla, you may want to make your hotel reservations now because they're all booked up. So as we, excuse the pun, slide into 2013, the industrial market outlook for Houston is very promising. With the energy sector, increase in jobs, accelerates our vacancy rate while our rental rates continue to stay strong and increase. With the completion of the Panama Canal in 2015, Houston's commercial assets will attract additional attention from investors. We will see increased activity in the Port of Houston and continued drilling in the Eagle Ford Shale area, and we can expect an increase in spec crane-ready buildings all around town. The Emerging Trends report stated that Houston is worth taking a chance on, and the Houston ports are very attractive. And the survey says their survey says that the main buying opportunities in Houston will be in the industrial sector in the coming year. So I'd conclude by just, congratulating the international and national community for finally recognizing Houston as a true gateway city, which as we know we've always been, but we're now in that high league of caliber recognized by the rest of the world. Thank you.